And I think part of the problem too is from like that 2008 time where builders went out of business, they stopped building as much. So we're technically now underbuilt. There's obviously a ton of builders that are still building, but I think not enough.
And regionally, like they're just not giving out permits in Maryland. It took us like a year and a half to get a lot of the permits that we did on the build to rent stuff that we did do. New inventory is not, solve the affordability problem.
Welcome to the Everyday Millionaire Show with Ryan Greenberg and Nick Kalfas. All right, guys, welcome back to another episode of the Everyday Millionaire Show. We are here with Jack Bevier.
Bevier, yeah.
Bevier. Okay, got it. Sometimes I screw up people's names and then I have to start over, but this time I think we're good. How you doing, Jack?
Good, man. Good. Excited to be here.
Nick, how you doing, man?
Doing pretty good.
Good. So, Jack, give me like a little background about who you are. Where did you just get started? Are you from Maryland? Did you go to college for real estate or something else? Kind of just a rundown of, how'd you get here?
Yeah, sure. So I grew up outside of Annapolis, like Edgewater, Davidsonville area, and went to school in Philadelphia, worked in New York for a couple of years in commercial real estate, but then moved to Baltimore to join Dominion. So my partner Fred started Dominion in 2002. I had actually interned for him when I was in college, and so that's how I came to know him. And then he ended up talking me into coming down to do real estate in like the end of 2006. I started early 2007 and just saw, nothing but a down market for a number of years. And so it's, I think, like 16 years fast forward here. And we've just been growing Dominion over the years. We do a couple different business models, but all around kind of distressed single family real estate. So yeah, that's how I got here.
So with that, you came on at like one of the craziest times in real estate history in our lifetime. What kind of challenges did you see when you got started? Were you on the way up into 2008 or you on the way down when you got started?
So I feel like I showed up in Baltimore. The joke I would say is like I showed up in Baltimore. It was like the peak. I showed up was the peak, and then it just started going down, and then it accelerated. Over the course of the next like 18 months. So I was like getting my introduction to the business in general, like while things are just falling off a cliff, and so it was a tremendous learning experience to have to go through all that, because we saw really everything that worked and definitely everything that did not work. And frankly, at Dominion, we changed rewrote all of our business practices to just stay afloat and like keep our heads above water, because it was just like survival mode for the first like 4 years. We were working like 80 hours a week just to keep the lights on. It was a really intense kind of like introduction to the business.
So during that time, what are some of the things that failed first in the business?
Yes. So one of the first things that we dug into was the rental portfolio. At the time that I started, we had like 175 rentals that Fred had put in place, and he was buying them at the Alex Cooper gallery auctions. They used to, you put pictures of the houses up on a screen and you'd start bidding, and people were paying like 50, 60 grand for $800 a month rentals. Like that was like on 3400 block of St. Ambrose. So we had like 175 houses that were kind of like of that ilk. And we would look at the financials, and though on paper they all should be making money, but they just weren't making any money. And so digging into that became one of my first projects. And one of the things that came out of that was the realization that for running a rental portfolio, that tenancy duration is like the metric is like if there was like one stat that I could like that it influences the profitability of a rental portfolio, it's how long do your tenants stay. Yep. And so we figured out that we probably were like 85% market tenants, maybe 15% Section 8 and other programs. And we saw that the market tenants were staying for 2.5 years, like 2.5 years on average. The Section 8 tenants were staying for like 4 years on average. And if you put those two portfolios apart, the Section 8 component was making some money, and the market rentals just weren't. And it's not because Section 8 versus market. It was the tenancy duration thing. That was like the real driver behind it. So that was like one of the things that we realized that like, hey, this is like a cash flow negative business. And at that time, cash flow was like tremendously important. or always is tremendously important. And so we started, vacating units and moving folks over to, re-renovating and then renting through different programs to try to get that longer tenancy duration. And had we not figured that out when we did and like got started on really being very focused on tenancy duration, I think that we probably wouldn't have been able to make the mortgage payments at some point during that, 4 or 5 year period, because we weren't getting any home price appreciation.
So what percent now is Section 8 versus market tenants?
Yeah, we're probably like 90% programs now. Again, it's less about working with the programs. It's more about just getting long-term tenancy.
And not having the turnovers.
Yeah.
So 2 questions. One, when you came on to Dominion, were you brought on as an equity partner right away, or did you have a salary when you first started? Because that might have been a scary time if you came on as an equity partner in a business in the toughest time of the market.
Yeah. So I came on just to do acquisitions. The idea was like, hey, I'll come on at acquisitions, give me a cheap salary, I'll stick around for a year. This was my deal. I was like, I'll stick around for a year. If at the end of the year you don't put me on the operating agreement, I'm going back to New York. Because like I had a great finance job in New York. I was, I was happy. I was having fun going out to the bars, and it was great. So I was like here for an opportunity. And so at the end of that year, though, we sat down and Fred was like, yeah, you know what? Like, I want you to stick around. Like, let's put you on the operating agreement. So I've always only ever like worked, basically been like, hey, I'll work for cheap, work my ass off, but get equity as a result of that. And that was just kind of the deal. And then Fred's been my mentor my entire career. So, and he was great to, give me that opportunity, and he's been a fantastic partner. So I've been happy with that deal. And I was in my 20s, right? Like I could cut that deal, right? Like I was 23, I didn't care. I kind of had, I could take a risk. And then it ended up, we just stuck with it and it worked out.
So for people out there listening who maybe want to do that same thing that you did and go to their employer or boss and say, hey, look, I want an equity position. How did you get the encouragement to do that when you did it? And what would you say to the people listening who want to do something like that?
Yeah, I mean, I think that the ability to do it, like doing it while you're young, is both makes it easier to take that risk. One, you just don't have anybody else to support, right? I was like, I need rent and beer money. That's it. And then I just worked a tremendous amount, right? Like you're not going to, someone's not going to put you on in an equity position if you're putting in 40. Like they want to see that that you're treating the business like your own, and that's 2 full-time jobs, right? So I think that, but I do highly recommend that approach to it. Like if you can go work somewhere for cheap, if you got the ability to only take out of the business what you truly need to make ends meet, and then show that you're going to build the business like through your working your butt off. I would like to think that there's probably a lot of entrepreneurs out there that would like that kind of partner. You're taking a big leap of faith there, obviously, right? Because if the guy screws you, then it's like that would really suck. But so obviously you have to vet the person and be eyes wide open about it. But I think that taking that approach, however, is it's hard to find a mentor who's going to seriously invest their energy and time into your professional development if you guys aren't aligned together, right? And so I think that combination is like there's a strong argument to be made to do it when you're young and can take a risk to do it. And then also just like being young in real estate is great, right? Because
you have time on your side.
Yeah, you have time on your side. Like it's a get rich slow business. So like if you can, the earlier you can get in and start building that equity, like time does heal a lot of mistakes,
Right. I have an intern at our office now, and I did a talk, like a financial literacy / investment talk to a bunch of student athletes, and he was in high school at the time and contacted me. Now he's 19, about to go to college, and he's working for us now as an intern, leaving for college soon. And I told him, I was like, dude, like if you took all the things that we're teaching you right now and you put it into play, like this year, next year, the year after, even while you're at school, like you're going to be set up so well when you are 30, 35 years old, because that extra 10 years that you get on most people when they're, most investors aren't investing at 20 years old because they've never learned about what real estate investing is until they're older. So I said, if you have that extra 10 years, that's like all the difference in the world that you need to be set up. By the time you're 35, if you work your ass off, that's it. That's all you need.
Yeah, yeah, totally, I totally agree. And like starting to build a rental portfolio when you're young. Like, I mean, I I grew up middle class. Like, I don't need a whole lot of money to like, to live comfortably. And so like, I mean, 10 paid off rentals is like a retirement plan, right?
Right.
Like, and so like you could have one a year in your 20s, and like, and as long as you don't, become, create for yourself an expensive lifestyle, like by 40, 45, you're done,
You're
like,
choosing when to work.
yeah, you're choosing when to work.
Yeah.
Exactly. Yeah.
So you mentioned now 90% of your portfolio is Section 8. Section 8 right now in the city especially is a disaster. It's been super tough working with them recently. Placements are taking longer. It's impossible to get in touch with anybody competent at the system, at the program. We even have Jack Resnick working with us who knows them really well. And what's been your experience with the system recently?
Yeah, I think, I mean, it's been like certainly cycle times working with all of the programs, and not just the housing choice voucher program, has definitely elongated throughout COVID, and hasn't gotten any better, right? Like now the whole world has like picked up pace, but they're still now trying to, get back in gear. And so they become the bottleneck, particularly on the leasing side. We used to expect, inspections within 5 business days, rent determinations within 5 business days. And now that's probably, 7 to 10 for each of those. So like what used to be, 3 to 4 week downtime working with the program has now become definitely 6 weeks at least.
6 to 8 weeks.
Yeah, 6 to 8 weeks. And that's frustrating, right? Because we have to like factor in another month of vacancy, which is, across a portfolio makes a big deal.
Right.
Um,
And I'm trying to explain this also to, on the management side of my business, trying to explain it to people that live in California, that live in New York. And I'm like, you just don't understand. Like it's not us. Like the program is just taking this long to move somebody into a house.
Yeah. And it ends up being a business decision, right? Like, we could not work with the program, right? Like there's no, source of income is a protected class. So that aside, but if you're like, hey, but I need to, I cannot wait 6 weeks to move in, you could just work with the market tenants. And so that ends up being a business decision, right? Like, do we want to wait a little bit longer, to have the credit enhancement, right? For us, it's the business decision is the credit enhancement of having that the tenant is always going to have just an affordable portion based off of their income. And so that's nice.
Right.
It was really nice during COVID when people were actually affected, their incomes were actually affected. So if you lost your job during COVID and you had the benefit of a voucher, your portion could go down. And so we didn't see a whole lot of credit loss. We saw people get behind, but then they don't want to lose their voucher, so eventually they catch up. So we've had like a lot of receivables, but not a lot of write-offs. And then the other factor is the tenancy duration. We just find that over the course of time, the program tenants tend to stay on
100%,
average longer. So it's super frustrating that their time frames have been elongated. At the same time, they've got a fixed administrative budget. It's a union shop. I'm not sure that, that there's and frankly, relative to other municipalities, when I've like just taken talked with peers in other areas, and I talk about they talk about what it's like to work with, the housing authority in their area. We probably have a pretty well run housing authority, relative to national standards, relative to like what we consider to be commercially reasonable standards. Like, no, I don't understand why it takes 7 to 10 business days to schedule an inspection. Like that doesn't make any sense to me. But,
and then a reschedule, God forbid you have to reschedule one, they're a month out now. And then we have to call and try to get an emergency one done. And it's like, it's just been every step of the way, it seems recently, it's just been such a struggle working with them.
Yeah. I mean, we there's definitely no silver bullets, right? Like we get in line like everybody else, and we call the office, and we, we're very very uptight about our communication and documenting everything that that went on, so that if God forbid some situation did lead to an abatement that was unjustified, we've been frankly recruiting the tenants to be advocates for themselves, right? Like they want to move in as well. They've got some housing situation that clearly they're not happy with, right? Which is why they're moving into this new unit. And so, they can be, them showing up in person to office hours and advocating for themselves has been, some help. But I'm not, and we haven't dug in we haven't dug in so much with Shannon and Corliss to like figure out like, is this a personnel issue? Like, I don't think they probably want to talk about it at that level, nor do I really nor can I do anything about it. Right.
Right.
So like,
I heard that there's like a lobbying group that people put together that they're trying to kind of help the system and come up with, I guess more streamlined processes that are less antiquated, that might take less time. But again, like it's like you're dealing with this public municipality kind of thing. Nothing gets done quick.
Yeah.
Unfortunately.
So,
Go ahead.
So I'm gonna talk about the different businesses within Dominion. Could you just break them down briefly on what they are?
Yeah, sure. So Dominion Properties is like our kind of our development side of things. So acquisitions, marketing, sales, is and project management all goes under that umbrella. So we buy houses, we renovate them, and then we'll either add them to the rental portfolio, or we'll wholesale, or we'll fix them up and sell them, flip them. And so that's the kind of the Dominion Properties side of things. If the property is kept in our rental portfolio, we've got like 4 or 5 different entities that we hold properties in. So there's just a bunch of different entities over there. And then Dominion Management is our in-house property management. So we manage about 850 houses. Call it like 780 of those are ours. 65 of those are third parties that we sold turnkey rentals to probably like 15 years ago. We just retained management and have just kept on doing it. And then our lending business is Dominion Financial. And so we do basically acquisition and renovation loans, like fix and flip loans, and DSCR loans for landlords, like 30-year fixed rate loans that we for landlords. And both of those, products we offer are nationwide. So we don't lend just in Maryland. Like though we do a lot in Maryland, we do lend. I think we have like open loans in like 43 states or something like that.
Awesome.
So pound for pound, which of those businesses is the most profitable?
The rental,
Recently,
the lending.
yeah, the lending business. I mean, 2021, early part of 2022, the DSCR product was like on fire, right? Like that, it was a new product to the market because prior to that, landlords always really had to work with local banks as their refinance resources, and so that's what we did. At one point we had like 16 banks on our balance sheet. When the DSCR loans, they've existed for probably 5 or 6 years, but in late 2020, they got cheap. And they got, because of all the crap that was going on, right? Just printing money and super low interest rates because of COVID. And so when the DSCR loans got in like the 5.5% range, they were like competitive with banks. And then we were like, oh my God, like if I don't have to provide 2 years of tax returns and wait for some analyst to like pick up my file and then ask me for like my extensions for this random entity that's not even involved in this, like a bank underwrite is like a freaking proctological, right? So if we didn't have to, if I can get the same rate and the same interest rate, not have to deal with that process, and I get that rate for 30-year fixed as opposed to just like a 10-year loan with a 5-year fixed period, that's like a game changer, right? Oh, and I don't have to provide tax returns. Like you're not going to do you're only going to do a property level underwrite on income expenses, not a global, not a personal, not a global, Like that's just so much more predictable, so much less painful, right? And so like you can really like run with that, right? Like if you know that product's available and you're building a rental portfolio, that's like a game changer, right? To like have predictable refis. And so as long as the rates are like competitive, it's just we think it's just a better way to go. And we refinance probably more than half of our portfolio into that product because of that.
Could you briefly define a DSCR loan?
Yeah. Sorry. So DSCR is debt service coverage ratio. So the underwriting of the loan is based off of the property level, the rent minus the insurance and the taxes, and the principal and interest payment. And as long as the ratio of the gross rent to PITI is greater than, you can go down to like 1.0, but really 1.2 and above is where you get the best pricing. that's the crux of the underwriting for the loan. So it's kind of, pretty easy to do. It doesn't take long to get a quote.
Yeah, so for people listening, if you are, looking to refinance or buy your first rental and you don't make a lot of money on paper, you can still do that as long as the deal makes sense.
Exactly.
That's what it really breaks down to.
Yeah, so that's like a total game changer, right? Because before, you had to have global debt service coverage ratio. It really made it a lot slower, frankly, to build a rental portfolio. You had to flip, you had to do other things to show current income to keep the bank happy with you so that you could keep getting refis. Now you really don't have to do that anymore. So anyway, my point being that we saw that being like a game-changing product for, frankly, the industry, and so we just kind of like went all in terms of like building operations around that product, and lending it nationally, and so that's become like the biggest part of our business.
And what does that take to get approved to start selling and brokering these loans out? Because I'm sure you're not the one funding them, right? You're brokering the money out.
Yeah, so there's a couple different things you could do, right? You can set yourself up as a broker, and then there's like 3 or 4 large companies like Torek, RCN, Kiavi does some brokering, Constructive does some. There's probably 5 or 6 other ones too, but those are probably like the biggest ones where you can just be set up as a broker and like just work through their portal and they'll fund the loan for you. We've started doing some of that business as well. We just call it like the third party origination side of things. Where you can just be the broker, you source the deals, you have to make sure that the loan conforms. But
do you have a license for that or something? Is there any license?
Not in Maryland. There's 9 states that this business to business lending requires a license. Maryland is not one of them. So in Maryland, it's just commercial lending. So you just have to learn the product and how to navigate it. So that's something that some people do. Now you're working with that entity's rates, right? And so you're a broker, so the rates that you're going to be able to offer to your customers are probably not the most competitive, just because there's a middleman, right? And then alternatively, if you're a little bit bigger than you, and you have like a balance sheet, so what we do is like we originate the loans ourselves, so we're actually funding them. And then within, call it 30 to 60 days, we'll sell that loan into the secondary market. So we'll originate it at, today rates are probably in the low to mid 7s. And we'll know that when we originate that loan, that we can sell that loan at least at par, which we'll try to sell it for like a little bit of a premium and get like 101 when we go to sell that. And that's part of the revenue. But to do that, and as a result, since we can close the loan ourselves and we can sell it in the secondary market, we can get a little bit better pricing. So we think that our borrowers are getting better pricing than if you're working through a broker. But the catch for somebody who, like a lender who's maybe doing like some private lending right now and says, hey, I want to go offer DSCR loans, you kind of have to be big enough where when you go to sell that loan, that the reps and warranty, that transaction itself, like there's risk for that loan purchaser, right? Like what if you originated a crappy loan and you sell it to them, they don't find out for like 3 months that like this guy didn't make any payments or like this transaction was based in fraud. So there's a master loan purchase agreement between you as the seller of the loan and them as the buyer. And they want to see a big enough balance sheet that the reps and warranties in that master loan purchase agreement are like, worth the paper it's written on. So there's a little bit of a gating issue. You kind of have to be big enough to be able to make those reps and warranties to be able to offer your customers the best pricing. But you can still do it as a broker, but you have a little bit of a disadvantage from a pricing point of view.
So I want to jump back to the rental side. At what point, if someone's out there building a rental portfolio, should they separate their acquisition as one business and then once it becomes a rental as another business?
Yeah, I mean, I'll tell you, the reason that it matters less now than it used to. The reason that it's good discipline to do it, right? So that you can like really understand like how each business model is doing.
And if it's worth doing.
Yeah.
That's the other thing.
100%. Yeah, I totally agree. And we set it up that way so that one, from a self-discipline point of view, and then two, so that when we were going to our banks, we could explain like how each business is doing. Like, we wanted to split them apart, right? Because we would say like, hey, it's, we operate 5 different business models, and it's not like, they'd be like, well, why are things up? Why are things down? And we'd have to like go into the details of 5 different business models and the fluctuations in margins and flipping versus wholesaling versus the rental portfolio. And it was frankly like a heavy lift for the loan officers to get through loan committee. So by separating everything out, we were able to talk more on a silo basis about how each business model was doing. And we tended to be looking for debt in the business models that were growing. So like that made it easier. Like, hey, yeah, we're looking for a line of credit for our flipping business. And the reason we were looking for this line of credit is because flipping is going great right now. Like, see, here's Dominion Properties, P&L and balance sheet. It matters less now with the DSCR loans to have that distinction, because no one's doing a global underwrite on you. Like if you're not going through the bank process, you're not subject to a global underwrite. That though could lead to some like bad behavior, right? Or just undisciplined behavior, commingling funds and not realizing you're actually losing money in a particular business model.
Right. And then the thing for us too, and we just split up our management. We had construction and management under one entity, and we just recently switched it. And it's been a heavy lift, as you said, just the bookkeeping, getting 2 separate QuickBooks accounts set up and this and that. And I think one of the biggest goals that I wanted to see is if our management company, which takes the most time and makes the least amount of money, isn't worth it, that piece of it I can break off and sell instead of being commingled with, a couple $100,000 a month in construction, that when you look at the whole balance sheet or the whole P&L, you can't really tell where the money's coming from. But now with separate entities, you can tell and then see if one doesn't make sense to do because it's such a headache. Sell off that business, dedicate that time to whatever business you have that's making the most money.
But would you sell your management company?
Yeah, you want it?
No.
I mean, that's like the whole goal, right? Eventually, I don't want to be managing all these properties myself. Like, if that number makes sense, I will know that based on my P&L that's just for that company.
Mm-hmm. Yeah.
Before, it was like everything looks great, but if you looked at pound for pound, the construction company is crushing the management company in profits.
Yeah.
So we knew that in our heads, but I can't prove that to a bank. I can't prove that to a potential buyer of the company. So now we had to split it up. And I think that's one of the most important reasons for keeping everything kind of compartmentalized if you're operating like you are in a integrated, kind of vertically integrated business.
Yeah. I think that self-discipline is like, I think that just the discipline that then imposes on you as well. Like, if you set up the accounting correctly so that each business is has a P&L and a balance sheet on a siloed basis, like whether or not you're being honest with yourself, like, right, like, because there's there's people involved, there's personalities been involved, there's like stuff that you like to do versus stuff that you don't like to do, like, and we're all human, right? So like we can tend to like commingle a lot of that stuff together. But like when you've got like, hey, here's the P&L and balance sheet for each of these entities on a quarterly basis, and you can see how they're doing, like, I think you probably make better decisions quicker, right? You're confronted with the reality of like, hey, I like to flip, but here's the thing, like, it's just not working right now. And maybe we need to, from a resource allocation point of view, like dial that back and do more GC work, for example.
Right.
Like, I mean, for a long time, I think that we flipped houses because we enjoyed flipping houses, but we were kind of slow at it. And so, and we weren't allocating our interest expense. We weren't capitalizing our interest expense on a particular project to that project. It was just all like kind of put together in a pot. Mm-hmm. And so we'd say like, hey, yeah, we made 30 grand on that deal. Or, we made, it was a little skinny. We made, we only made 20 grand on that deal. And then if you really doubled back on it though, and allocated the interest expense that we paid to the bank and our private investors for that flip, well, they actually made 15 of that 20. We just had it in this little bucket down here, and it wasn't job costed. And so we were like, dude, we did all that work for $5,000. Like that was dumb, right? Like we could have wholesaled it for 10.
Right.
And so that transparency, I think it helps you make better business decisions, especially as you scale. Like it's important to have that transparency and not just always operating off of your gut.
So how do you guys determine when you're going to wholesale versus flip versus keep it a property as a rental?
Yeah, I mean, we'll just do kind of like a highest and best use analysis for each one, one of those, and we're guessing, right, as to like, hey, I think that I could wholesale this and make 15, if we retailed it ourselves, we could make 35. And if it was a rental, we would be in for, 110 times rent. And, and that's a 6.25 cap. And so we do that analysis on each deal. And, for the rental side, we look, with an honest expense ratio, which is tough tough to be honest about your expense ratio, especially before you're factoring in turnovers. But with an honest expense ratio, like, all right, this is a 6.25 cap. Well, I'm borrowing money right now at 7.25. So am I willing to lose a point a year? Right now, I'm not that excited about that. So I've actually been pivoting a lot of stuff away from rental because the cost of capital is just higher right now. It's harder to make a rental deal work. And then, versus, all right, if we flipped it, we could make, 35 grand, but we got to do a bunch of work and take market risk, and there's a lot of energy that goes into it, versus making like an easier, quote unquote easier with the wholesale, like 15, like, and then we just make a judgment call of like, is that extra 20 grand worth the energy, worth the effort? And that's more of like, what's the quality of the location? What's the quality of the house? How quickly do you think it's going to sell? How backed up are, like how much availability do our crews have right now? Am I trying to keep people busy, or am I like backed up and we're not going to start this thing for 6 weeks? Mm-hmm. And so all those judgment calls, all those factors move over time. And so, I still make that decision on every house. But I've got great acquisitions people who like are almost always giving me the right answer. But at the end of the day, I still like do that judgment call.
Gotcha. And you guys have done your fair share of new construction for rentals, right? How does that cash flow on a new construction property compare to the cash flow of a property that, let's say, was an existing building that you just rehabbed?
Yes. So the expense ratio is lower out of the gates, but your cost basis tends to be a little bit higher. So I think it's really difficult to make build to rent numbers work today. In 2021, I was really excited about it because we were borrowing money at 4%. So like, the build to numbers, I can build to a 5.5 cap and it's fine. Like,
and your maintenance is way lower. And
yeah. Like even if I'm in for 110 or 120 times rent, my expense ratio is 35% instead of 45 or 50%. And the debt's cheap enough that math still works. It's still accretive to add that property as a rental. Today, I think it's extremely difficult to build to rent and then borrow money, at a 7 handle, and make those numbers work. So we've actually, some of the stuff that we put in our pipeline as build to rent, we've recently pivoted and said, hey, we just, today I can't make it work. I'd love to keep it as a rental. It'd be a great rental, but expense ratio would be really low. But it's just not accretive to finance that thing, and we don't want to have a ton of cash stuck not earning anything, and so we've been pivoting stuff to more retail these days.
What do you think the rates will be next year?
Man, I hope they come down. I'm a little. I'd like to think that they'd be coming down. They should come down because like credit spreads are real high right now. Like the amount of risk premium we're all paying as borrowers right now is like kind of at an all-time high. But at the same time, the concern about recession is still 6 months out, and the Fed owns a ton of mortgage-backed securities that they need to get off their balance sheet at some point. So they're going to be selling, if it's conceivable that they'll be selling mortgage-backed securities into the market, which is going to potentially keep spreads wide. So like, though I think that we are overpaying as borrowers right now, frankly, like I think we are overpaying as borrowers for the risk profile that we present to a mortgage lender. I don't know that. I think it may be a year or more before things actually start to come down.
Do you think that's because the Fed is really just waiting for the housing market to come down before they make a move downward?
Well, I think that the Fed's doing what they're doing to impact, to get inflation down to a place. And though they're correlated with mortgage lenders, I think mortgage lenders are thinking about it like the Fed's setting short-term rates, and mortgage lenders are generally thinking about lending on a 5 to 10 year basis, because that's how long in general we tend to keep our mortgages outstanding. And so I think it's, the 5 and 10 year, if you look at the Treasury yield curve, the 5 and 10 year is actually, is much lower than the 2. So it's cheaper to borrow money for 5 years than it is for 1 year or 2 years right now, which is, the inverted yield curve. but the lenders who are making those mortgages are just so they're just requiring, they're just getting paid more, right? Like the amount they're charging over the 5-year treasury is a lot higher than it normally has been in the past. And I think that's kind of because they can. Like, I feel it's a bit opportunistic.
Because it's like the rates are really keep going up, but it doesn't seem like the price of the home, which is I thought what their goal was, to really drop. You know, maybe some are in the lower spectrum of home prices, but you know, anything from $500,000 and up doesn't seem like that those numbers have been affected at all.
Yeah.
If not opposite of what they tried to do. I mean, the demand is still high, the supply is still low. Is there any, you know, in your opinion, obviously we don't have a crystal ball, is there anything that's going to change that? Is there any kind of like, you know, do you think there could be anything like incentives to build more for builders like us, or like what do you think is the next move to get this, you know, kind of back on track
From housing prices?
yeah
Or?
from like the Fed's perspective?
I think that I think that they are factoring. I think they're factoring in housing as like a component of inflation, but they've already tempered that, right? Like, you know, housing prices are pretty much flat. It's
I guess my question was, do you think they're trying to make them come down, or is flat enough for now?
Oh, I think flat. Well, I think that they are trying. I think they're trying to drive them down. I think they're trying to drive them down. But the thing is that home prices are really sticky on the downside because people just then don't sell. Right? It's an emotional investment. It's, you know, it functions, you know, in an emotional way. And so people just, you know, if they're going to take a loss on something, they'll just like stick around. And it just tends to be sticky on the downside. Now, by the way, though, like if housing prices are flat for 5 years in a row, which I think is conceivable, that we just don't see very much, if any, home price appreciation for a while, and there's still some inflation, we're actually losing money on a real basis, right? Like after inflation. And I think that that's not usually the case. You know, usually it's the case that housing is an inflation protected asset. But I think that for the next couple of years, I don't think that the asset is going to have the same benefit of being inflation adjusted. I think we could see 3 years of flat home price appreciation while we have, like, you know, 5, then 3, then 2. And we've actually lost 10 points, you know, from a real point of view. So yeah, I think to answer your question though, I think they'd like to drive housing prices back down because they think that this 20% run up we had in 2021 was just craziness. And, you know, they wish that had never happened and they were trying to unwind it. But I think it's sticky to the downside, and it takes 5 years to unwind a year and a half of mania.
And I think part of the problem too is from like that 2008 time where builders went out of business, they stopped building as much. So we're technically now underbuilt compared to what we were, you know, back then. And there's obviously a ton of builders that are still building, but I think not enough, essentially.
Yeah. And regionally, like they're just not giving out permits in Maryland. Like it took us like a year and a half to get a lot of the permits that we did on the build to rent stuff that we did do, or the new construction stuff that we do has been like really frustratingly long process.
Right.
And so like in this region, there's like new inventory is not going to save the affordability, is not going to, you know, solve the affordability problem.
What does the construction side of Dominion look like as far as, do you guys have in-house contractors? Do you guys sub out for everything that's done?
Yeah, so we have we're like our own general. So project management is all in-house. So we act as our own general. We have a head of field operations, James, and then he's got really 3 project managers in the field and 1 person in the office. So and then we've got an in-house crew who does like turnovers and punch out. And we've got 6 guys there. And other than that, everything is subbed. So like, you know, if it's demo framing, all the trades, the trim crews, you know, obviously roofing, siding, all that jazz is all subbed out, and we just act as the general. And then when it gets to like, you know, close to punch out, we just say like, hey, just give it to us. Cause like following up with the trim crew on punch out is just brain damage. It's really painful. I feel
like to punch out on any house that we do, it's like the most.
You have to have a dedicated punch out. We have 2 dedicated punch out crews, and that's the only way we've seen it work. There's no way that the same guy that's framing the house is going to be able to punch it out at the end. They just don't operate the same. We've tried it. We've said, you know, stay here until it's finished, and it's never really finished until you send out those guys that actually know how to punch out where the caulk goes, everything. I mean, it is a necessary part of a construction business is to have two guys for every couple of projects that's all they do. They go there and punch out. That's it.
We used to we would do I would say let's just hold back money, just, hit them in their wallet and, motivate them through their wallet. Right. And, but it was like, if you hold back $1,000 or $1,500, they're like, dude, that's not fair. Like, that's just clearly unfair. But if you hold back 500, they just don't care. Right. And there was no sweet spot in the middle where we could actually affect behavior without being an asshole, so we just said, screw it. We'll just take punch out of their contracts and we'll do it ourselves. So
for somebody now that's starting out with being really tough to find good deals, being tough to get good rates, what should people do? Do you think people should be holding off on buying rentals if they're getting started to, save money if they have a job? But all these people now want to do, they want to be rental owners. They want to be investors. But it is one of the toughest times to do that with these rates in our lifetime anyway. What is your opinion or, I guess, advice to those people that are just like kind of on the fence? They're ready to go, but they just can't seem to make any of these deals work.
Yeah, I mean, because of the low inventory of deals, developing a skill set in acquisitions is still like kind of table stakes to be involved in real estate. So like starting with wholesaling I think makes a ton of sense. I think that it's then kind of and then learn construction management and estimating so that you can then make the transition into being able to do flips, which also gives you the optionality of going the rental route too. But I think that just given where cost of capital is right now, finding a deal that with an honest expense ratio makes sense on a rental basis is, I'm not saying it's impossible. There's still deals, right? But like it's easier to find a deal that works as a flip than it is as a rental. And like you said, we home prices haven't really been that affected. Like the top line's flat, but it's still flat. Like it hasn't come down that much. Right. And we've started to see some seller capitulation because people are concerned about upcoming recession or don't think that home prices are going to start going up again. So the realistic motivated seller we've started to see some capitulation there to find deals that make sense at like reasonable spreads. I mean, 2 years ago, I wasn't, it was like either wholesale it to someone new, who's just got like some money to burn and, they're just looking for a project, or keep it as a rental. And these days we're kind of back to a much more balanced mix where flips are, I think, a much more viable, mix in our strategies. So I think that and that's where folks should focus, right? Like get good at acquisitions, then get good at construction. Right now, I think that like you could build a rental, add a rental or two that, cherry pick to build your rental portfolio, but don't push to build your rental portfolio, because I think you'll end up making mistakes and cut corners on the rehab, and you'll just be paying for those mistakes for a long period of time.
What strategy are you using now for the ones that you are keeping as rentals? Are you still doing DSCR loans, or are you going back to the banks?
Yeah, I'm using DSCR loans. I'm trying to go back to banks because we found a couple banks that are a little bit cheaper than the DSCR loans, but we're definitely because those yields are so tight right now. If I can get an extra, 35, 40 basis points off of the rate, it actually makes a difference right now from a coverage point of view. So I'm trying to work with banks, but it's really, really challenging. I think it's probably the most challenging that I'm the most motivated to get that cheaper money right now, and having the hardest time doing it. So we're still doing a lot of DSCR loans.
And what, at where you are now in your business, what is the challenge with working with the bank? Obviously, we know there's a ton of paperwork. They ask you for letters of explanation about every freaking dollar that you've made in the last 3 months or whatever. But you guys have, a very, your business is set up, it's established. What is the challenge now that you're dealing with? Like, you can't just give them your balance sheets, your P&Ls, and say, hey, look, we're making money. Can you lend to us?
Yeah, the challenge is that the rates at most of the banks, the rates just aren't any better, the DSCR loans. Okay. Given where their cost of capital has gone, right? Because the cost of deposits has gone up like 400 basis points in the past 6 months. So like they used to have an advantage because they had cheap deposits. But then after the banking crisis, through and after the banking crisis 90 days ago, their incremental cost of capital, both borrowing from the Fed's overnight window and now where they're getting hurt really, where it really hurts for them is the deposit rates. Like we're all demanding, we're not just giving them, savings accounts with a couple $100,000 in it and taking our 0.7% APR on that. Like we can now demand 5% on our deposit accounts. And so that means that their cost of liabilities is now 5%. So they don't want to lend us money that anything that starts with a 6. So like the bank term sheets are 7.5%, plus. Yeah. And man, 6 months ago, like we try to be like really in that market to always have every 6 months we'll do like a big survey of send our financials and a tape of a refi tape to like 20 banks and just see who's motivated, right? Like see who's got the best term sheets, and it's moved around. And we did it a year ago, and we had probably had 5 or 6 banks to choose from that were like definitely better than DSCR rates. Today I got one, and it's like, all right, I'm gonna do this. I'm gonna see how far I can run with this bank, and then I think I'm definitely just doing DSCR beyond that. So the rates aren't better at the banks right now, but I think that the process hasn't changed a whole lot. Maybe loan committees are a little bit more conservative because they're just because they're being because they're getting pressure, they're concerned about their commercial real estate portfolios and their incremental cost of capital is higher. So they don't want to, no one wants to make any mistakes right now. And it's kind of easier for them to make mistakes right now. So I think that there's a general tendency for loan committees to be more conservative. The underwriting process itself is the same, but they're just also, given where their incremental cost of capital is right now, they're not putting out better terms to compensate for either of those factors. And so like the unicorn bank that is like worth it is, for me right now, there's one.
Yeah. So I think it was maybe a year and a half ago where the bank's rates were always, I thought, at least 1% lower than percent lower than DSCR loans. And then recently I've been trying to refinance a mixed use property. And I called the bank, and it was the same amount as I'm paying for, the residential.
The fees are usually less, though, typically.
Yeah, they're a little bit less, but
the term's less too. It's a 5-year loan instead of a 30.
But right. You guys recently came across a note buyer who can do these deals, but the interest rate right now is it's really high to where it's just, I don't know if it makes sense to refinance it or just try to sell it and just make a little bit of money on that side. So it's definitely
on a mixed use deal.
Yeah, mixed use. Yeah, I got quoted by Anthony the other day, and it was like I think like 8.7%.
Yeah, like that. It just doesn't make sense.
It's hard money.
Yeah, plus points. Like it's if it's like a fastball rental property, those rates are still in the like the low to mid 7s. Mm-hmm. But anything with like exceptions or features or that doesn't fit the securitization guidelines, like they just get priced like they give you I don't really want to do it price.
Yeah.
Right. And I don't think that's going to stop. Like, I think that is like what we've really been feeling that wave hit us over the past 6 months, but I don't think it's going to abate. I think I think that's just where we're going to be for like the next year or so. And it's just going to be like a kind of like, I was talking to Fred about this today. I feel like it's going to feel like a little bit like a slow strangle where like everything's hard. Loan volumes or like deal volumes are down. Interest rates are higher. So it's harder to make money on rental properties. And so like, if you're good at acquisitions, you can wholesale and flip, but like making money right now, I feel like for me right now, the focus is like, just go make money, like make money to get to the other side of this, because this isn't sustainable. Like something's got to give, but that something got to give is probably that like some competition doesn't make it through, and then margins come out because people don't make it through. So for me right now, we're in like defensive mode. We're just like, hey, if we can make some money on it, make money on it, and like let's just make it through to the other side of this, because this isn't sustainable.
Is that kind of like the next year's goal is to just sell what you can as far as flipping, and then wait until the market cools off as far as the interest rate to buy more properties?
Yeah.
And then do you guys have like a number goal as far as like how many rental units you guys want to have?
Nah, not really.
Just continue to grow.
Yeah, I'll probably be I'll probably be a net seller of rentals this year. Like we'll probably We bought like 100 2 years ago. I probably only bought 75 last year. I'm probably by, between 75 and 100 this year, like we're on pace to, just total houses. But I think I'll probably, whereas 2 years ago we kept 75 of those 100 and add them to our portfolio, I'll probably keep 20 of those 100 and wholesale and flip everything else. So yeah, we're more focused on just monetizing everything to make sure until we feel the coast is clear, until it's obviously a good time to add rentals again.
Do you guys invest in anything else for the time being?
No. We're kind of stacking cash, trying to make money wherever on every deal that we can. And then the lending business is still like fine, right? Like people still need DSCR loans. And so that we still run a profitable business there, but we're more focused on profitability over the next 12 months. That's like our primary focus right now.
The banks are like you were saying before with like savings accounts and stuff. I mean, my bank, I use Shore United. They have a product right now that we're starting a CD. It's a 5.5%, 12-month with no pull-out penalty. So you get one pull-out within that 12 months so that's like basically a high interest savings account essentially for 5.5%. If you're looking at your rental portfolio and your true expense basis, like truly looking at vacancies, everything, it's probably not that much better on like from a macro standpoint than that 5.5% if you're financing at a 7+% rate. So that's personally what I'm trying to do. We're also selling off a couple of rentals right now, putting money into those CDs for somebody that's listening that has capital that's sitting in a checking account waiting for that first deal. Maybe it's best to put it somewhere that's getting 5-6% interest or whatever you want to call it, and hold it until that deal does come up. Because if you're sitting with significant amount of money in your checking account, you are losing money right now.
Yeah. To your point, I think that actually one of the most interesting opportunities right now is private lending. Whereas because even the biggest fix and flip lenders in the country right now don't have a cost of capital advantage like they did 2 years ago. Like 2 years ago, Kiavi could borrow money at 3%. And so they could do fix and flip loans at 8 and 1 and like just crush everybody because they had to borrow money at super cheap rates. Now they're borrowing money at 9%. That's the securitization market for fix and flip right now. It's so much higher. And so they don't have a cost of capital advantage over your local private lender. So your local private lender offering you money at 12 and 2, 12 and 3 is like maybe 100 basis points higher than like one of the nationals will give you. And so lending to those lenders or just doing direct to investors, and you getting whatever they're raising money at 8, 9, 10% is a great place to, if you find somewhere where you feel safe with it, right? That they're not just out there calculating with your money, but a good operator. I think that's a great place right now to get some yield with cash that's sitting on the sidelines. And the person who 2 years ago would scoff at your 10%, today that's not so bad. Like that, for operating capital, that's it's hard to come by. The banks are lending money, it's 7s and 8s. So like if you're offering money out of 10 with like easy terms, it's nothing to scoff at right now.
Right.
Yeah. Absolutely. So if anyone listening has money out there, I'll take it all for 10%.
No points. So Dominion Management. So that is your kind of in-house property management company. This is more me being curious. Have you not owned any of those properties and you were managing that portfolio for somebody else, all other outside? Would that business, do you think, would be profitable?
No. Yeah, I run a break-even property management company, and I'm fine with that. I've never been able to get it to like really make money.
For your model, it makes sense. You have such a heavy portfolio that you own.
Yeah, it's just for us, it's about control, right? Like, and we've also probably set it up a little fat because my point, like the point for me, like the win for me is in maximizing NOI, not creating a profitable property management company. And so I think there's, frankly, I can run the property management company a little fat and save more than that incremental cost in NOI, right? Or get a better NOI for being a little bit higher service, a little bit like, just a little fatter, right? Having just, making sure that nothing falls through the cracks. And so, yeah, for us, like I've always found property management to be it's a low margin business. It's incredibly important for us. It's about control. And at least in Baltimore, I've never been able. I don't really know. Baltimore is a tough place to run a profitable property management company. Like it's a high, that's a high service, hands-on business. That's
Right.
my perspective anyway.
You're giving Ryan reason to sell his.
So the whole reason that we have one is because we're vertically integrated and we help clients do acquisitions and construction from California, New York. There's no way that I can't have it right now.
That makes sense.
But it is something that like I said before, it takes up most of the time and makes the least amount of money.
Yeah.
So I'm just like, I love talking to other people that do manage and like, what the heck are you doing that I'm not doing? Or maybe it's just, that's the business. This is what it is.
I think it's a strategic, like to your point, it's extremely strategically important though to be able to offer that, because if you're trying to offer construction GC services or turnkey or
Right.
work with investors who are out of town, like they need a turnkey solution, and if you only provide 3 of the 4 pieces,
It doesn't work.
yeah, like and even if you found another property management company to be that 4th piece, like you can't run your 3 pieces as nearly as profitably as you could if you controlled that 4th. So like for me, it's just let it break even. Like it's just a services business that breaks even to make everything else run smoothly.
What does your property management team look like?
Yeah. Employee structure.
Yeah, so I'm a little weird. Like we don't have like the typical structure of like, hey, here's the head property manager, and then everyone works for that property manager. Ours is a little bit different. We have basically division of labor between like leasing and compliance, which would typically be your typical property manager background. But then we have an inspections manager who is at the same level, and then the maintenance manager who's also at the same level. So we do so much program work that I actually needed like an inspections manager just to manage all the inspections process, all the annuals and the pre-contracts. So we have those 3 people really kind of work as like a team, but they're all like at the same level. And then, so we have somebody who, so we basically have like, 850 units under management. So under leasing and compliance, we have someone who's a leasing manager in the office, a dedicated person who does showings, and then a person who does delinquency coordination, like, follow up with tenants on delinquency and then showing up to rent court and making sure that, if there's an eviction that gets scheduled, making sure that that'll happen. So delinquency coordinator for us is its own position. The inspection manager has one person in the field, so he kind of runs the office and does some field work, but then has a kind of like a runner to meet inspectors. We found that if we don't attend the inspections, the results are materially different.
You have to be there.
Yeah. So we've just embraced that. And then on the maintenance side, we have 2 folks in the office for like dispatching and invoicing. And then we've got, right now we only have 1 in-house tech. I'd really like to, but I don't want to be there. Like I wish I had 3 or 4 in-house techs, and then a bench of probably like 8 or 10 subs that do different kinds of maintenance work. That's us.
I didn't count. How many people is that? Yeah.
It ends up being like 15 people, and then accounting. And then really 2 people, 2 equivalent full-time employees in accounting. So it ends up being like 15 people.
Okay.
15 people plus techs.
Okay.
Yeah.
So
which is I think a little fat. Yeah.
Yeah,
I think
yeah.
that's a little fat.
And again, half of this is me looking at my outfit and doing some math and being like, okay, are we properly staffed? Are we overstaffed? Are we understaffed? Because again, I'm literally just trying to figure out a way to make that business just a little bit more profitable for the amount of work that it's been taking us.
Yeah. Yeah. I follow.
So I have a question. You both can answer it actually. So at what point do people in your office file a failure to pay?
Good.
So we've recently, this is just recently after our new hire, have been calling on day 6 and then telling them on day 31 or 32, however you want to look at it, depending on the month, is when we file.
So like 1 month behind?
Yeah.
Like 1 full month?
Yep.
We're doing the first late on the 5th. We start processing filing. We start processing filings on the 15th. So between the 15th and the 25th, we end up filing.
And do you guys notify them in advance that that's what's going to happen if you guys don't receive the payment?
We do.
Yeah.
We're in a process where like on the 6th of every month, we're going to start calling them. And then they usually tell us, oh, we're paying next Friday. We're paying on this date. And then my new strategy, this was within the last like 2 months, we put an activity into AppFolio. Just say on this date, this person said they're going to be paying. So if they don't pay on that date, that's it. We file. So if they said, okay, next Friday I'm going to pay, I said, okay, great. We look at next Friday. That's an activity. It comes up in our calendar. If my admin sees they did not pay, that means they lied to us. That's it. That's what we're filing.
Yeah. Yeah. We're similar to that. Yeah.
I think that's so crucial because when you start letting people, it's like you give an inch, they take a mile kind of thing. And if you multiply that by dozens of tenants, it's the back end work to clean all that up is just disastrous. And then you're losing out on an extra month or a couple weeks of vacancy or not vacancy, but non-payment, which is a killer.
Do you do, let me ask you, do you do payment plans? Like if someone gets 2 months behind, you know, they're behind, making up a number, you know, $2,500, and they say like, hey, yeah, you know, I'm gonna pay $625 in 4 installments plus my regular rent. Like, will you not file?
So here's, I can't answer that truthfully because there are situations where we've done that before, and certain situations have worked out fine, and then others have blown up in our face. For my own properties, I would say I'm a little more lenient because I can take that, you know, and
It's on you.
It's on me, right? And for other people's property, I basically have been kind of asking them, giving them the situation. Hey, the tenant called, said their dog got hit by a car and they had a vet bill and they couldn't pay rent. What is your thoughts on that? And it's their asset. It's their money that I'm managing. So I have to kind of go by them, and I'll say, look, like they've been there for 2.5 years. They've paid every single month until now. I think maybe we give them some leniency. But I also just had a tenant yesterday who moved in yesterday and said that they couldn't pay their first month's rent, or like they were moving in yesterday. Like we didn't give them the keys, waiting on the first month. They security deposit, everything. They're like, and this is a Canton, like $3,200 a month rental. And they're like, oh, we can't pay this month. There's 4 roommates, whatever. And we're like, that's not going to work for us. Like this, if you're either going to pay or we're giving you the security deposit, half of it back. We offered half of it back, and that's it. You move on, we'll move on. They ended up paying. Huh. We gave them the keys today. But, you know, it has to be situational. Mm-hmm. You have people that do come into problems. And I guess my next question for you, Jack, is like, what's your demographic of property? Like, what's the average value and average rent? Because we have properties that we manage in Canton, for example. We have a heavy 4-bedroom, 3.5 bathroom Canton portfolio. That's what we build. That's what we sell to people. A lot of chap properties. That's our kind of market where our office is. Those properties, very different than, you know, properties in 21218. It's so those, you know, situations definitely look different. What does your portfolio look like? Is there a big kind of gap between the highest and the lowest, or what, you know, are you kind of average?
Yeah, I would say like over the years, it is kind of like progressively moved up market. Like 15 years ago, we were adding stuff in like very transitional neighborhoods, like we got a ton of stuff in Bel Air Edison, Evanston Village, Allendale, you know, Waverly. Those are like that's like, you know, was like core stuff for us, very middle of the road. I mean, we do have, and, you know, plus we would like, you know, steal a property in 2000, you know, in 2011, you in stuff that was in a tough location, you could get a great deal on it. Right. So I got stuff on the 1000 block of Cary Street, 1800 block of East Lafayette. Like I got, you know, Wilkins Avenue. Like we do have properties that are in very tough locations. So that's probably at this point like 10 to 15% of our portfolio. The vast majority of it is that kind of like middle of the road that I was just talking about, Allendale, Bel Air Edison, kind of stuff. And then really like 4 or 5 years ago, we started buying more and more in the county. And most of the stuff that we've added over the past 4 years has been Baltimore County, Harford County, and like, you know, prettier stuff in the city, like, you know, some Canton stuff, some condos.
I love Harford County. Stuff. No rental licenses, no lead specs, nothing. It's like the Wild West kind of still up there.
And it's super affordable. I really like Harford County.
Yeah, we have a couple in like Abington that we manage, and Edgewood and stuff. And you find good people up there, and they're great rental properties.
Yeah.
Low compliance. That's our, you know, compliance in the city is tough to keep up with. And that's one of the things that Nick and I have been discussing, because I just got a ton of properties under compliance that people gave us to manage, and it was like 30 properties that we needed lead, rent, the whole gambit. And the city's tough. Like, you have to keep up with that stuff, or they're gonna punish you. They're gonna either put your house up for tax sale, which we've had almost happen. They're gonna send you fines, whatever. You can't evict people. So finding those places with low compliance is definitely we're learning to be crucial.
Yeah.
So when I'm going to ask this question of yours, when you think of retirement, you retiring, what does that look like to you, and what do you think like you need for retirement? Is there a certain amount of money? Is it just like your happiness level? Like what is your kind of plan with that?
I think that I would be really bored if I like wasn't doing something in business. Like I genuinely like doing business. Like, and it's fun. Like, I like doing deals. Like, it's an intellectual stimulation. It's a creative outlet. Like, so I don't think that I will ever like, truly retire in that sense, in terms of just like, sipping martinis on the beach. So I think just having the ability to choose which projects we do next and choose my level of engagement in the business is like, for me, that's always been the kind of the goal. And so something that took several years, like, we got the business to a place where it was like profitable and running well. And like, in theory, you could like retire on the income. But we were still very involved, and we didn't have a choice but to be very involved. Like, we were still making, between Fred and me, most of the decisions. And that probably took us, 4 or 5 years, or 3 or 4 years to then kind of bring in managers, pay people more, honestly, to bring in the level of people that we could then truly like look away and like not worry, like, sleep at night, and that to know that the business was being run well. And so we gave up a little bit of profitability to afford those people, but we were buying our time back, right? And buying that optionality back, for ourselves. And so then we can, and then at that point it was like, now we can choose our level of engagement, basically. So that's for me, that's like what I would consider retirement, is like, you're choosing your level of engagement. Not that I'm going to like not know what's going on.
Yeah. That's what I agree with that. I feel like I can't, like, I wouldn't be able to stop doing any type of business stuff. I would always want to be engaged in some way, shape, or form.
I talk about consulting. Like, I would like to go look at other businesses that were similar to mine, that are just starting out or having trouble, that I can go look at their books and go to their office and see their operations and then help them in that way. I think that'd be cool, like problem solving, like from a global standpoint in a business. I thought that, to me, was like maybe like the end goal of all of that stuff. Now, just one question about, and this is something that we've just started kind of ramping up, and your salary. I'm not going to ask you how much you make, but from a percentage standpoint, if your business, let's say 100% of your net profit, how much are you and your partner taking as a salary in percentages, and versus how much is going back into the business for reinvestment, growth, that kind of thing?
Yeah. So one thing that we've always done, and we've never changed it, is that we just keep everything in the business. So like, we only take out like literally what we need to live. Okay. Fred had a wife and 3 kids. I had a bar tab. So like, I needed less. And I've taken a little bit more when I got married, just so I could, buy a house and stuff. But we've always been very like, only take the minimum out of the business. Out of the business, and reinvest. We've always just reinvested everything.
Is it the same amount for you and Fred that you take?
It was more for him, just because at the time, well, honestly, it didn't like it. It was $55,000 when I started at 23, and it stayed there until when I was 23, it was $55,000. At 30, I bumped it up to 70, and that's it. And like, I've taken some distributions out over the, more recently I've taken some distributions out because like, we bought a 21-foot chaparral, like we bought a boat, or like we'll go on, my wife and I'll go on some vacation. So I'll take a distribution to do stuff like that. But we just like run it very, very lean and only take out what we need. And I just, we just think the opportunity cost of that capital, like what I can do with that money myself, I'm like, it makes me very reticent to want to like spend on frivolous stuff, because I'm like, my opportunity cost of capital in my mind is like 20+%, right? Like if I can't, my job here is to deploy capital at 20+% return on equity. So like the opportunity cost of me taking that money out is 20% on that money. And that's like that perspective has kept me like just wanting to leave it all in the business.
So at this point, what is Fred's role and what is your role in the business?
Yeah. So Fred's still very, very active at work every day.
I'm assuming he's an older guy.
Yeah, Fred he's like in his mid 50s.
Oh, okay. Not that old.
Yeah, he's not that old. He's me like, you fucker. He's not that old. So he still comes to work every day. He's very active. We're both like I kind of oversee property management and property management and like the properties operations. Like those folks report up to me, and then in the lending company, kind of business development, marketing, underwriting, and sales report to me. And then Andy oversees most of the other operations in the lending side of things. So Fred is more on the lending side of things. He's he is certainly the face because he's the founder and owns most of the company. He does the like larger transaction negotiations, so kind of like the business development side of things and the larger transaction. Like if we're putting together a new warehouse line of credit, like he'll take point on that until the term sheet's signed, and then he'll hand it to me and Andy to then go implement. And then on the properties and real estate side of things, again, he's like the face for all the financing and investor activities. And then but he knows everything that's going on. So today, for example, we have bi-weekly meetings, like Tuesday and Wednesday, every other week for me are just meetings all day. And so I try to like organize it that way so that I can get reports and get the KPIs from everybody on every part of the business so that I only have to do those 2 days. Now I'm still end up working 60 hours a week just because the rest of it's fun. But I only have to to stay up with the business. I only have to do those 2 days. And Fred and I both do all of those meetings. And so we have a pulse of what's going on. And if there's a judgment call that needs made or someone just wants input or someone to bounce stuff off of, he's always available for that.
Are those meetings with all the employees?
No, just the managers.
Gotcha.
Yeah.
Yeah, so we've had this where we have a couple of big meetings with all the employees. That's project managers, property managers, all the people in the office, people in the field. But it seems like for us, those meetings are less productive because there's too many people with too many different problems that the project managers don't need to hear the property manager's problem and vice versa. And it's kind of, when I look around the room and I see how much money we're spending per minute on this meeting,
I think about it that way too. Yeah.
I'm like, wow, there's 12 people sitting here and we're talking about one person's problem and I'm paying all 12 of them to be here. Yeah. That's just super counterproductive. So what you do, compartmentalize meetings as well? Yeah,
we do departmental meetings, and it's like we use like an EOS style. You guys read the book Traction?
Somebody on our podcast brought this up though. I forget who it was, but somebody did bring this up, and
it's really good.
I'm blanking on it.
Yeah, we really like it. We both read the book, and we were like, we should model things after like that. So we haven't done exactly an EOS implementation, but it's pretty similar, and the way we run our meetings is very similar to the way that they suggested. So it's that basically so in those meetings we're getting reports from each department, and but there's a KPI for every activity in the company. And so there's a number for every activity in the company. So I can read the set of reports, and that's frankly all I need to know. I don't need to hear any stories. I know exactly how things are going week over week, and we track it. We've been doing this for probably 6 years now. So I can look back at all the reports and see how the business is doing over time. And that's been very helpful, because it makes it a very quantified, expressing the business in a very quantified way. And then so I'll look at the report and I'll circle this and I'll circle that. And then I'll ask about that number and ask about that number. And then there's some stories behind those situations or numbers or, whatever. And so that's kind of how we we'll then zoom in from there. But we're starting with a purely quantitative representation of what's going on operationally.
Awesome. Yeah, I'm going to have to read that book because you're the second person that talked about it. And now I think maybe it was Terry Royce that brought that up with the KPIs and doing all that kind of measurement. And and I think that's definitely something that I gotta look into.
Mm-hmm.
It's been great for us. We really enjoyed it. Yeah.
Well, Jack, thank you for your time. I don't want to take, we're over an hour here. I really enjoyed the conversation. Super helpful. I think our guests will be inspired that, you know, there are people out there that are normal people that are building massive portfolios like you guys are. And it's cool to hear, you know, you're still having some similar problems that you had in the beginning and you solved a bunch of problems. So that's cool. I appreciate your time, man.
No, yeah, super fun. I really appreciate you guys inviting me on, and I really enjoyed it. That time really flew there.
Yeah,
Yeah.
it did. I was like, I looked
Sure
at the
did.
thing. I'm like, damn, we're an hour, 15 minutes in already.
Yeah.
Holy shit.
So like and subscribe to the Everyday Millionaire Show now on YouTube and all of the audio platforms, Spotify, Apple Music, all those good places, Apple Podcasts. So give us a like and subscribe and talk to you next time.